We're back in your life.
We're kind of back in your life because I'm on holiday.
You're on holiday.
I've got hair.
I don't have, well, I've got hair now. I won't have hair. We'll talk about it next year. But this episode, since we're all on the beach having a good time, we've got some wisdom from our guests over the year.
There's a really interesting thing about guests, right? You can learn by listening, doing, and taking people as advice who have already done it. And boy, did we do a lot of that.
So there's heaps of really good pearls of wisdom in here. So enjoy the episode. Much love to Partners Life for sponsoring. We'll catch you in 2025.
Today, we've got an extra special guest, Reagan from Where's My Money, here to talk about how he's getting himself out of $1 million worth of debt.
This was the end of last year. Me and my partner had realized that pinch was really gripping us.
Yeah.
And I just started to panic. We were out of money. Our mortgage structure, back step, we owe $1 million to the bank after we bought our second house. And we were living off our revolving credit. So our plan was to earn more than we spend, pay off our mortgage a little faster. But with rising interest costs and rising costs of everything, we realized that the balance in our revolving credit was just hurtling towards zero, and we were basically 3 to 4 weeks away from hitting zero.
Wow.
How does that feel? When you conceptualize that, because we deal with a lot of people in different situations being financial advisors, but often it is like the head in the sand mentality, even when you know the train crash is coming.
Yep.
People put their head in the sand and go, oh, it'll work itself out. So what does that feel like when you're sitting there, you look at the math and you go, holy crap.
It's horrifying. It really, it's opened my eyes to how much money can actually play a part in how you think and feel and behave and live your life. Like it shouldn't be like that, but when you're running out of it, it really does. So I think trying to put it into words, because it's been a while since I've spoken about it in the podcast, and we've come such a long way, but to put myself back in those shoes gets really stressful again. I'd been cognizant that it was happening and wanted to protect Laura from thinking about it too much, because she's a new mum. She's got enough on her plate.
Yeah.
As the breadwinner, this is very traditional household roles, but I thought, I'm responsible for this because I earn more, so I should be taking care of it. So
I'll figure it out.
I'm going to protect her from that stress. And we'd come close a couple of times to kind of being in that situation, but I'd earned a bit of extra money from some extra side work, and it had kind of kept us out of it, So that little saving grace didn't happen this time.
Yeah.
There was no out. So we needed help. And after where we'd got to with buying houses, it makes me sound like I'm a learned investor. I am not. But after doing what we've been trained to do as Kiwis, like go and get a degree, meet the woman, try and marry the woman if she's nice, buy a house, start a family. We'd done all these things. So we were like on the trajectory to the Kiwi dream. So I didn't want to feel like, and I also didn't want my partner Laura to feel like we'd fucked it up or we were moving backwards or something was going wrong. So you want stability in your life. My job had been changing a couple of times. So stability is just super important. And I don't know, you just want to feel like you're doing right by your family.
Yeah.
But again, looking back, doing right by your family is admitting something's wrong and actually going and getting it fixed. It's the interest rates that really cooked us. When we bought our current house with $1 million worth of debt, we paid $1.42 million for it. God, that's a lot of money. It's not even properly insulated. Like, what were we thinking? Interest rates were 2%. Our monthly repayments were roughly $4,000, which was yummy, sweet candy interest rates. And now
it's true though, right? Like that is a sugar high interest rate.
That's what I love. I love it when the economists talk about like the candy rush or the sugar hit.
Yeah.
I'm like the sugar water. I'm
scram.
like, it was. I remember that. I was like, wow, so affordable. And now our repayments are $7,000, and that's so much money.
Yeah.
And realistically, we've got help and we're in a better situation now. I'm sure we'll delve into that a little further, but our debt to income ratio, regardless of what interest rates are doing, is no bueno.
Yeah.
So something's going to have to give.
Yep.
Eventually.
When you sold your first house,
Yeah.
you mentioned there was a period of time where you sold the house. Did you rent for a period of time? Is that right? Or did you just go straight into buying the new
We
house?
went straight into buying. So we had our first kid, and he was just turning 1, and we'd gone through COVID lockdown, and we were like, we need a bigger house. We have a big dog. We'd spent a lot of time in this 2-bedroom kind of duplex house. We'd renovated the kitchen. We'd put a deck on the back. We were like, this is a good time to upsize because we needed something bigger. We were sick of being stuck in this room. And we'd added value to the property. So we're like, this is a great time. And during COVID, obviously,
we've done the right thing.
we had done what we'd been told, like add value to your property.
Yeah.
And again, at the time, property values were going through the roof. So selling was a good time.
Yeah.
We put our house on the market, and it was online for 6 days. We had 1 open home. We had 50 couples come to view it. There was a line down the street to get into the open home because it was COVID. People had to wait outside, so it made it look like demand was hot.
Mm-hmm.
There was also 4 other private viewings in and around the open home. So within a week, we had 10 offers. And a house that we paid $685 for 3 years prior to that, we then sold for $980 for a 2-bedroom duplex unit
Whereabouts?
in Te Aratu Peninsula.
Yeah.
East
So
Auckland.
you feel richer because you've gone, we
Oh
made
my-
like 300,000.
Watch this.
Yeah.
Yeah.
We'd caned it, and we'd only spent 40 to 50 grand on renovating
Mm.
it. So we
Yeah.
were like, we'd made $250,000.
Yeah.
Like,
And
dream.
Yeah.
and what was your mortgage at that point?
So we paid $685. We owed $560 on it.
Okay, so your mortgage was about 560 grand, and at that time as well, right? There's always concern about the economy. Interest rates are continuing to come down. You're going, money is just getting cheaper and cheaper.
Yeah. It would be stupid for me not to go bigger.
That's right. And I'm thinking about how little debt that was at the time. Interest rates were like 4.8 when we had the house, and that's kind of what we expect
It's a normal rate.
Yeah.
Long-term normal.
So we sold the house, and we had a pretty short settlement. I think we had 3 months to find a new one. So we were going to auctions, and we had pre-approval all of a sudden because my income had just gone up. I'd got a pay rise recently, plus the newfound cash deposit we had from the sale of that house. All of a sudden, the bank was like,
Have at it.
motherfuckers, you can have 1.6 million.
Rock
Buy a
and
house
roll.
for 1.6.
Yeah.
We were pre-approved.
Buy Disneyland.
Buy
Do
Disneyland.
it.
We were
Take an island.
pre-approved
Yeah.
from buying a first house for 680 grand. The bank was then like, you can buy one for 1.62, and we're happy with that.
Almost impossible for because I was a mortgage broker at that time, and I just started becoming a mortgage broker. And I always say it's not always like the good times. Or I actually, when you were running through, we had the house on the market for 6 days, 50 couples, 10 offers. I was like, I had forgotten that. Like exactly what it was like. You could not lose. You literally you could do anything and win. Yeah.
And what we did too, because we were already going to auctions at that point, we decided to go negotiation on it because we wanted to appeal to all the people that were losing at auctions at the time too, because we were in that exact same boat.
Yeah.
So if we can give people an opportunity to come and put their offer on the table without having the stress of an auction, I think we attracted a few more people in. So I think we were playing quite a smart game at that point. But all of a sudden we were armed with, the bank's told me I can afford a $1.6 million house. This is awesome.
Yeah. And what was the conversation you were having with your spouse at that time? Going like, should we max this out? Is $1 million of debt too much? What were those?
Did you even have the
conversations?
Did you even think about it, or did you default to the bank has said yep, so it's got to be a good move?
I think that it was mostly that. It was mostly the bank has said, well, the bank's the experts.
Yeah.
They're the money
What do I know about
guys.
this?
They have
Yeah.
all the money.
Surely they wouldn't lend me this unless they were so comfortable I could do this.
Totally. And when I looked at the numbers, I was like, we would owe $1 million. And at that point, like if we maxed out, we'd owe 1.2. Like, I don't think we had properly had the conversation. It seemed like a bit of a, well. Because at that time, though, we were more focused on finding a house rather than what we could afford.
As a sign of success?
Totally.
Yeah. If I think about that through my head, I remember when I got just thinking about I would see that as, guys, we're shopping for a house. We can get 1.6.
Yep. I just got a pay rise and a promotion. I felt I was on top of the world, you know. We'd started our family, we had the dog and a kid. I was like, this is the Kiwi dream. This is it. But our focus wasn't on what we could afford necessarily. It was what we could find with the time frame. We didn't want to rent. I saw that as a waste of time and money because it costs to move. It costs us, there's setup costs involved, and
It's a pain.
Yeah, it's a pain. So we needed to find something to move into that was going to be perfect for us immediately. And we went to a lot of auctions. We lost all of them. And then a colleague who I'd known for a very long time who lived in the same neighborhood as us was like, we're actually thinking of selling. Do you want to come and check our house out? And I was like, hell yeah, cool. So we literally walked from an auction that we lost, got in the car, drove straight to this house to go check it out. And we were like, this is actually perfect. It's got all the things we want. It's got a backyard for the dog and the kids. They said we can keep the trampoline, it's got nice wooden floors. It's got 3 bedrooms instead of 2. The kitchen's modern. It's not super flash, but it's like perfect for us. It's got a deck, yada, yada, yada. It's in the right neighborhood.
Perfect.
It's perfect. And they're keen to sell it to us privately. So we don't have to, there's no fighting for it.
It's literally perfect.
Yep.
Yeah.
So we put an offer on what we knew would have gone for. We offered the 1.4 for it, knowing if it had gone to market and people would have fought over it, it probably would have gone for what we were approved for, which is 1.6. So in our mind, we were still ahead of the game. And technically on paper somewhere we'd made 200 grand again, because if that went to auction, we probably would have lost it again. So we went for it, and not really thinking about the fact that we had jumped from $580,000 worth of debt to more than $1 million.
So you settle on that house, and interest rates at the time, I'm guessing, were about 2%, were they?
I think we were like at 2.1.
Yeah, okay. And then, so your mortgage repayments at that time
$4,000.
were very manageable?
Totally manageable.
Yep. At what point did you start to go, start to look at it and go, this is getting a little bit uncomfortable?
I think the first jump was pretty much, it was like from 2s to 4s pretty quickly. And that was a spicy kind of, I guess we'll have to swallow it kind of thing. Because at that point,
it's still all right.
And there was no cost of living crisis at that point. Nothing else had started to spike yet. There was no inflation. Groceries were still kind of normal. Insurance companies hadn't started to really pump price. It was all just, the mortgage got a bit more expensive. That's okay.
Maybe we'll go out to dinner once a week instead of twice a week.
That's right. And because of this cushion of our revolving credit, we'll just swallow it. But
we've got some buffer.
Yeah.
Do you remember what your mortgage repayments? So they're at $4,000. Do you remember what they jumped to?
They probably jumped to 5.5 pretty quickly.
Okay.
Yeah.
And at that point, you were like, "I'm aware of what's happening. I feel the difference, but I'm not super uncomfortable." Is that where you were at that point, or were you feeling quite?
I've at that point started to just head in the sand. Just
It'll be right. Everyone's going through this.
Everyone's going through it. I'm comfortable. I'm sure I'll get another pay rise soon. I'll complain about it to everyone because we're all in the same boat.
Yeah,
And
everyone's complaining about it. Everyone's in the same boat. It'll be fine.
The more people that agree with me, the better I'll feel about it.
Yeah.
Interest rates then jumped again, did they?
Yeah.
And
it was consistent. I mean, we thought we'd kind of gamed the system by splitting the mortgage in 2 and having overlapping fixed 12 months. So every 6 months we'd have to refix to kind of weather the storm, or
more gradually.
More gradually, but it didn't really make a difference because the jumps were so huge anyway.
Yeah.
I think when our revolving credit balance came down to like $3,000, it was like, we're going to miss the next one.
Yeah. And what were those conversations you started to have?
They were tearful. They were, there was not much sleep. I was, my skin broke out. I was terrible at work. I was constantly in a shitty mood with Laura and the kids. It was just, we had a second kid by this point, it was.
That adds some stress.
Oh, yeah, totally. Sleep deprivation on top of it. It was just, it was not a nice time to be around me.
Yeah.
I was just walking around work just angry at everyone.
Pissed off.
Yeah.
And in hindsight, were you able to, with how stressed you were you able to go, here are the options. We sell the house and rent, or we go talk to a financial advisor? Or do you think there was just so much kind of noise in your head about it all that you were just almost paralyzed?
Yeah, paralysis by analysis. I think I needed help, and I had to go to a financial advisor. I knew that selling the house was an option, but I didn't want to do that alone without good advice.
What was the advice that you received in that meeting?
The first lever we pulled was to go on a mortgage repayment deferral, immediately, because we were that close to running out of money. We needed to basically claim hardship at the bank. The other thing I've left out is that Laura was on maternity leave, so she wasn't earning.
Yeah.
That was the actual biggest last punch was we were down to one salary, and so we had about 3 days before Laura went back to work. Laura went back to work 4 months after having our second kid because we needed the money.
Yeah.
But we managed to get in time before her first salary had come through. So technically we were still in hardship, and therefore we got 3 months of full
repayment holiday.
Full holiday, not just interest only. It was full holiday.
Yeah.
And that was, obviously, we know that comes at a cost because it's just deferring that interest. But we knew that we just needed 3 months to stabilize, to really build a budget. We'd never stuck to a budget before. We'd just bought what we needed and rolled on with life. So we needed 3 months to stop flapping in the water, get our heads above the water, create a budget, stick to it, and start moving forward and build a bit of a surplus. Even though the surplus is a little bit artificial, it's there now. And it's kind of bought us more time.
Mike, in terms of financial hardship, I mean, I'm assuming you've had a lot of those sort of conversations over the past few months and last couple of years. A lot of people would go, "Oh, I don't want to do that." Why? In what scenario is that a good, lever to pull?
Well, it's a good lever to pull if you are staring down the barrel of not being able to make your repayments. And a lot of people are really hesitant to talk to the bank because they think they're just going to come in, whip the house out from underneath me, and it's all gone Pete Tong. Actually, your bank has a vested interest in you making the repayment. They don't want to sell your house. It is expensive. It is costly. It is time consuming. Then you've got to be the banker who's selling someone's house. Like, it's just not a great thing to do. So there are, and at the moment they are a lot more receptive, lenient. There's a lot more things you can do now than there kind of previously was, even say 7 or 8 years ago. They still have criteria they have to hit. They are lending institutions. They can't just be pushing pause on everyone's mortgage, but they are definitely there to help, to make sure that you can try and stay in the house and at some point repay, catch up, and keep going.
There were definitely hoops to jump through. It wasn't a fast process. They definitely made you prove it.
Yeah.
But realistically, what's more paperwork compared to having to sell the house?
Yeah.
They were non-judgmental. They were good. But again, it was a lot of work to get it done.
Yeah.
I think it's the word hardship that probably scares a lot of people off. It makes it sound like you are, realistically you're in a shitty position, but it sounds like failure. It sounds like you are,
You've gone from
busking.
that 1.6 million being a sign of success to
a charity case. Hardship
Yeah.
sounds like you.
I'm a hop, skip, and a jump away from living on
city
Queen
mission.
Street. Yeah,
Exactly.
Tell us about where you're at now. So you first got financial advice.
Yep.
When did you get that? We're now sitting in August 2024. Give us an update on your situation.
We got we first started getting advice in December last year, and since then we've obviously built a really stringent budget that we stick to every week. Every Wednesday night it's money night.
I love that.
So we go through every transaction that we've made as a household that week, and we code it all so we can track all of our categories, how we're going in the takeaways category versus groceries. Are we overspending on gas? Why?
Do you use software for that, or do you manually do it? Or?
Yep. Software called MoneyFit.
Yep.
It's just really easy to use. It just tracks all the accounts you want to connect to it. We're still allowed to use we still use our credit card to earn some extra air points on the side. I know that that's sometimes a bit of a trick, but we've done the maths on it, and we are still
and
getting.
If it works for you, it works for you.
We're getting free air points out of it, which means Laura can go and see her family in Wellington a couple of times a year.
Perfect.
So that's good. We can see how much we're spending. We're open about who's spending what. We can. It's a forum to discuss what's next.
Yeah.
we probably still shy away from that topic a little bit at the moment because, again, we want stability with 2 young kids. One's 4, one's 1, so we don't want to make any bold decisions just yet. But for the moment, we're stabilized and we've just got confidence in the fact we're not shuffling backwards.
Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand operated award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below. Today, we've got Scott O'Neill, Group CEO of Rethink Group Australia, commercial property guru, here to talk about his story. In the residential space, the cash flows are looking pretty average at this point. And a lot of people are starting with those multi-units and obviously kind of ending up on the commercial side of things as well. So you got about 14 residential properties in one hit, was it? Or
yeah, so it started moving much quicker up there. Like I was getting paid more as well, which was big tip for anyone. If you want to build your portfolio, just chase those jobs that pay you an extra 20 grand a year. Like if you got to travel, like I was just upping the salary every time I did that, more lending capacity. So didn't have to start businesses, didn't have to like pull rabbits out of the hat. I just was getting paid more naturally through career progression. So portfolio grew with the career, and then the strata tiling idea came out. So this is what kind of really got me to that 14. I was buying pretty worn down unit blocks. This is at a time when they weren't really focused on. Nowadays, like everyone's all over them. So like the yields are much tighter, and you've got to. Basically, I was buying, let's say there's 5 units on one title. They might be worth $1 million, but separately they might be worth 250 each. So they might be, 1.25 mil. So there was upside in the numbers through strata tiling that would clean up a new deposit for the next deal. The yield was sort of maintained each time, so serviceability was good, but I still ran out of serviceability, and that's where after the 14, back in this is like end of 2015, so 5 years later, started looking into the commercial space.
And when you had that residential portfolio, loose numbers, what was the value of it? What cash flow wise was it giving you any money? Were you topping it up? What did it look like? Yeah,
so look, interest rates were a little bit lower back then, but I was like, it was circa kind of 10 mil type territory. And, I was getting 6-7% gross yields each time. And so net yield. So it was, I would have been about 50K ahead after all expenses. So, not shooting the lights out, but enough to kind of, get by. And obviously it was all about pushing the rents up when you could, hoping the property's value would go up. And like the asset base at 10 mil at that age, I was still quite young, early 20s. It was a good asset base that I knew in 10 years that 10 might be worth 16 mil, and that's where the good stuff happens.
And that's an incredible achievement having that size portfolio. Did you have how did it happen over time? Was it just you bought one and then you were like, I want to be able to get the next one when I did? Were you, financial literacy, growing up? Did you have a mentor? How did it happen?
Well, look, 2 things. I got exposed to investing very early. So my dad helped me buy some Telstra shares when I was 12, 13, really young. And I'd noticed the dividends coming in. It was $12 to dividends. So nothing, because I was only investing a small amount. But it gave me the idea from a very young age, you can put money somewhere and then it expands, $1 turns into 2, that, basic kind of analogy. And that just meant I never thought money should be in a bank because you can do better with it. So, and there's different levels of risk. So, I always watched the stock market rather, and always enjoyed it. I remember year 10, we had an assignment where it was a hypothetical. If you had 100 grand to invest, and it was a competition who to invest, and I came one of the top in the year because I was buying things like Qantas shares and a couple of specky type things. And I just really enjoyed watching what the companies were doing. But the real kind of, to answer your question, how it all worked is I just obsessed over property. There was no shortcut. I would, every chance I could at work, I'd be sitting on those spreadsheets, those engineer ones. I had every property that I looked at in a table, rating them from yield to risk to, age profile, like pros and cons, like, and I'd
Here's the
quantify.
engineer.
Yeah, it is. Yeah. It was always coming.
Yeah, exactly. But like that's what you got to do. Like, there was no one that was going to do it for me. It was just like, how do I kind of weigh up all these opportunities and just looking at them nonstop? And I was letterbox dropping. Like I had this great job where I literally was managing sand mines and concrete plants all the way from Port Macquarie to like, over a 500 kilometre stretch, basically up the north coast of New South Wales. And it just meant I could sort of see unit blocks. Like that's what I was targeting at the time, pre-commercial. And yeah, like I was just saying, look, I'll buy this off market for above market rate. That was my letter.
Yeah. Call me. Yeah.
And I didn't really get any calls.
Yeah.
That was the worst bit. But because there was not enough good stock online. And that's what I was starting to realize. The resi unit block strategy was dead. This is kind of now getting into the 2016 era. And basically what happened, they all went up really quick in value, but the rents didn't. So the yields were not as good. And the opportunity was, 2 years ago, basically. So commercial, looked at a random shop in Port Macquarie, and the yields were like 9% net, which in today's terms is amazing, because that would be probably a 5-6% net for the same deal. So that's where I was like, all right, the numbers work again. The spreadsheets look beautiful at that point.
All about the spreadsheet
numbers.
Yeah.
My eyes lit up.
Let's go through that. I guess that scenario where you kind of looked at the shop. Like, was there you just running the numbers in your spreadsheet, going, this is getting tighter, this isn't making as much sense. But then what was the thing that, did you always kind of have some interest and start to educate yourself on commercial property? Because in the webinar that we did last night, we talked about the biggest obstacle is understanding, right? Yep. Residential is so easy to understand. How did you just stumble across that shop, or how did it all start?
Well, I was quite experienced in residential at that point, and what interests me was the cash flow. Like I didn't look at the shop and go, I'd love to own that. Look, to be honest with you, it actually had resi on it. So it was residential up top and then the shops down the bottom. So I was like, oh.
You got catfished.
Yeah, exactly. So it was kind of like I got moved into it accidentally. And then I thought, well, why do I want the residential at the top? And so I then started looking at pure commercial, and the numbers got even better. As you know, finance can be a bit tricky for those mixed use types as well. So I found that out. And then basically, commercial, it was the numbers. To be honest with you, it wasn't the types of properties. Nowadays, I kind of get more excited over certain deals because I kind of understand the growth rates of different asset classes, how secure some investments are versus others. But back then, it was just a cash flow equation.
Yeah. Okay. And then so kind of you've taken the commercial property pill, so to speak. You've gone in that direction. How did it? Have you like retained all your residential portfolio? Did you end up selling off some assets? What happened?
Yeah, good question. I got to about, like, I actually looked this up a little ago. So I've purchased about 40 odd properties and I've kept 29 of them. So I did buy a lot and sell a lot of residentials. I plan to sell I think I've currently got somewhere about 12, 13, 14, something like that. But it did get it much higher. But yeah, the reality is I will sell them down because they don't solve any problems for us now. They just create problems because of the maintenance. They're growing in Australia as well, and there is a time where it's going to peak. So I want to kind of sell off just before whenever I believe that peak is, and it's not far because there's a lot of change and regulation happening in Australia. That it's getting more restrictive. But residential, and I always say, you need residential in your portfolio. I've never really met someone who has 100% commercial. I've met a lot of people with 100% residential, but the best investors have a bit of both. You start with residential, let you build your equity up. It's low risk. You can kind of find your feet on it, and then you move into commercial, and that's where you kind of actually retire.
Yeah. And then we've got the residential portfolio. You're starting to look into the commercial stuff. How many did you kind of purchase before you thought, I'm going to make this my business and I really want to have a crack at this?
Yeah, it was as soon as I started looking at it, I kind of knew I was onto something other people needed to know, because I looked for about a year before buying, and the only information I could find was stuff out of the US. There was no podcast, there were no Australian books I could find. there was zero information. So I was kind of like just relying on like local agents on the ground for information. And as you know, they represent the vendor. So they're telling me what I want to hear about their specific deal.
But not necessarily 100% of what I need to hear.
Yeah. Or if you talk to a competitor agent about a competitor's listing, they just do the opposite and say it's terrible.
Oh, it's trash,
like,
man.
it's just
You'd be an idiot to buy that.
Yeah. There was just no advice that was, really looking after me. So it was just manual. And like I asked my parents at the time, because I was still younger, what do you think? And they're like, don't buy it. You're an idiot. I asked locals in Perth, because that's where I bought. They're like, nah, Perth's crashing. Don't touch it. You're an idiot. Like I literally got told by about 10 people, do not touch this deal because it's going to fail. And, as we mentioned last night, it was just a little supermarket, 400 square meters, and a fish and chip shop, about 150 square meters. And there was 2 deals. Both businesses have been operating for multiple decades. The fish and chip shop was around for 35 years. So, a lot's gone down in 35 years in Perth in that period, yet it still survives. So, like, this is a safe bet. Everyone doesn't know what they're doing. Yeah. And everyone I asked had no commercial experience as well. Yeah. And that's the other thing.
Everyone's got an opinion, but where is this coming from?
And where do you find a commercial investor to give you advice? Because back then, 10 years ago, the only investors, well, there weren't many. They were mostly just owner-occupiers, like guys or girls owning a big shed where their business was running out of. And they're just doing it for different reasons. Yeah. So, and then the other investors were fund managers, and,
they're not going to talk to you.
Exactly. Yeah. Different ball game. Yeah. Different price point. So.
And when you're buying that transaction, because we always talk about this, right? It's the same as, buy low, sell high, but it's very difficult to actually get people to buy at the bottom of the market. Yeah. You've got everyone you're asking you saying, don't do this.
Yeah.
You're an idiot. You don't know what you're doing. What's the thing that gets you over the line? Is it just looking at the numbers, or do you have something else where you're like, you know what, stuff it, I'm going to go do it?
Well, now I'm trained to actually see that as an opportunity. Like this is the old Warren Buffett saying, be fearful when others are greedy, and greedy when others are fearful. Like, and it's really hard to do that in practice. And that's by my first property. Like, it was just after the GFC. I was literally reading article after article on mainstream media saying there's a 40% crash happening.
Yeah.
Like, all of them were saying the same thing. And then you go onto chat forums, and I was obsessed with chat forums back then, like, because that was information, and like all these nobodies are just massively opinionated on exactly where the direction of the market's going. So no one was really going heavy in 2010, but if we had a crystal ball and knew what would happen, you just load up on everything you could back then, much debt as possible, and you would have made a lot of money.
All obvious in hindsight, right?
Yeah. And that's sort of why I'm like in New Zealand now with, helping New Zealanders with commercial property, because I see this as an opportunity. Like, your interest rates, you had 5.25% interest rate rises in total. That's massive. And then the market's kind of tanked a bit in certain areas. Yields have now got better, and now you're on a downward cycle with interest rates. And like a lot of Australians are actually looking at New Zealand too. And the first thing they do is scoff at the interest rate because it's still a little bit too high.
Yeah.
So they're all going to wait. They're going to wait for the interest rate to be perfect. That's what the masses will do. It's the worst thing. You got to get in while there's a bit of pain. Don't get in after it's perfect, because as soon as it's perfect, every vendor's going to want more money because they know they can get it. You're up against 10 times the buyers. But human psychology is very powerful. You can't switch it.
It's like the resi market, at the peak of, end of 2021, where, we're talking to people and there was that FOMO, everybody wanted another property or that kind of thing. And you're like, well, interest rates are like 2%. Have you run the numbers to make sure this is all good? And they're like, just give me the thing. Like,
they're looking at us like we're idiots. And we're like, are you sure you want to do this?
Yeah. And to kind of back that up as well, like I was getting asked by New Zealanders because our business model helping commercial investors isn't in New Zealand. And 2021, I was getting quite regularly New Zealanders wanting to help in New Zealand. So I looked at it. I looked at your interest rate, and I looked at the yields on offer, and the yields were just terrible because everyone was paying too much. So basically, the more you pay, the more the yield looks lower and lower. So it just didn't make any financial sense. And I'm very happy we didn't get in at that time because, we would have suffered 20-30% fall.
We've got the founder of Williams Corporation, the managing director, Matthew Horncastle.
here to tell us about his story.
We talk about it, Matt. You got to have like the clickbait at the start, right?
Yeah.
They go,
okay.
why should everybody listen?
Well, let's give them the clickbait. I'm Matthew Horncastle. I'm the managing director of Williams Corporation. Williams Corporation is a residential property developer. We've been in business for 12 years. We've delivered 1,900 houses to our customers valued at $1 billion plus GST. So the 1.15, but we got the billion without GST now. I've been claiming the billion for a while, so because I put the GST in a couple of months
You
ago.
knew you were going to chase up
I
an
knew I was
extra
gonna-
15%.
And so we've done $1 billion of property development plus GST. We have development offices in Christchurch, Wellington, Auckland, and Tauranga. We have a sales office over in Singapore. We have a business development support office in the Philippines.
Yep.
We're very good at what we do. We build a lot of houses. I think I need to jump back to how I did my first project, because there'll be a lot of people that want to understand how you do your first project. And we didn't make any money from it, so I'm not pitching this from a wealth creation perspective. But
For all the bloody dentists and doctors out there who go, I'm just going to start developing, let that point just really sink in.
The doctors are the worst.
And
every doctor wants to be a property developer. I'm like, when are you going to do this, man?
Andrew Horncastle calls it the Matthew Horncastle effect, where every young buck thinks he can just build an unreasonable amount of townhouses because we make it look easy. But so essentially what happened was, right through this crazy period of creating all these companies, we went on Trade Me and we bought the cheapest block of land on Trade Me. So it was a site in Aranui, Christchurch, which is one of the poorest areas in Christchurch. The site was $60,000. We didn't have $60,000 liquid because it was all tied up in this failing business. And a guy that was doing our foundations, Richie, shout out to Richie, you legend, he said, I'll JV you on the first project. So what happened was, and this is a guy that I would drive sledgehammers with working on construction sites. Like, he knew I had work ethic, knew I had ambition, and he asked me if he could fund me on a project. So like, that shows if you go there and you work and you do the work, opportunities come to you, but you have to be in the arena doing the work. And so Richie said, I'll front the $60,000. So Richie paid for the land, B&Z paid for the construction, and we built one house. And we made $14,000 from it, $7,000 each. So it was pretty sucky. But what it did is we built a house, and we now had a track record that we'd built a house. And so fast forward to this empire's come, this little empire. We're probably doing $2 or $3 million a year of revenue then, give or take. Might have been a bit more. And so our little empires come crashing down. And I said to Blair, we've got two options. We can go work for someone else. We pick one thing. We get all the money we can, and we do it with all of our heart, all of our soul, and we won. And that choice was obvious, right? And then the decision was what thing? And I said, well, I really enjoyed building houses. And he's like, yeah, so did I. And I'm like, let's do that. So we started building these standalone homes, very similar to what you see in traditional New Zealand construction. And so we went from building, it was like 3 to 12 to 40 or something like that. But there was no real wealth accumulation, no real money made. And we were sort of just struggling to keep our heads above water, struggling. And I said to Blair one day, I'm like, I really want to be part of the Christchurch rebuild. I'm like, I know we have no money. I know everything's hard. But we're just building houses around in the burbs. How cool would it be if we were part of building the city? And he's like, yeah, that'd be cool, but we've got no money. And I'm like, but what if we did? And so I went on Trade Me and I found a 300 square meter site for sale for $150,000. And on that site, there was one 3-bedroom, 150 square meter house planned. And the house was probably worth $750 to sell, give or take. And so I'm like, let's buy that site. And Blair's like, oh, and I'm like, no, we're doing it. We're buying that site. And I sat down and I used to hand draw all of our plans. And I sat down and I cut the site into 3 and the house into 3. And I said, wouldn't it be cool, instead of building a 150 square meter house with 3 bedrooms, how cool would it be if a young buck could buy a house in the city and we could do 3 one-bedroom houses? And so I sat down and I drew these 3 one-bedroom houses with a living downstairs and a bedroom upstairs and a bathroom. And we priced it, and there was the same size as the 3-bedroom house. And I called a real estate agent and I'm like, what would these be worth? And he said, I literally sold a house just like that for $360,000. He said, there's a huge amount of demand for it. And now you're bringing in, for the same construction and the same thing, instead of bringing in $750, you're now bringing in $960.
The margin.
So all of a sudden it's like, there's quite a bit of money in this. And I'm like, okay, let's, if this works. And then I thought of Robert Kiyosaki, if it's such a good idea, why don't you do 100? And so I went down the road and I bought another site because I'm like, I think I'm on something here. I think this is going to work. And for some reason, I brought the other site to market before this. And we had 10 one-bedroom. So we had a 600 square meter block of land and we had 10 50 square meter one-bedroom townhouses on it. And we gave it to an agent and he sold them all in 36 hours. Not unconditionally, but for the sake of the story. Yeah. And I'm like, we're on.
We've cracked
and
this.
And just to put it back into context, right? Like these are your big sites. At this point, you're not really making any money. That must have been like a pivotal change.
It was a pivotal moment. It was going from, because we had that early win and then just a couple of years of just really hard.
Grind.
Really hard. And then I was like, we're onto something here. I'm like, this is it. I'm like, no one's creating that young professional, the investor stock. No one's creating central, affordable townhouses. And so then we just cranked. And I'll just sort of discuss the volume for a minute so I'm accurate in my numbers. But we just cranked. I'm just opening up a spreadsheet, which obviously, because we're now recording, is just being really slow to open. But we went from building.
Give us the year or the age as well, if you can.
Okay, so FY16, we built 3 houses. FY17, we built 20 houses. FY18, we built 40 houses. FY19, we built 61 houses. FY20, we built 178 houses. FY21, we built 335 houses. FY22, we built 494 houses. FY23, we've built 503 houses. And the current financial year, we've delivered 278 houses. We'll end the financial year on 450. And then we have 300 scheduled for the following year, just because sales have been a bit slower in the current economy.
And so that one site with it was 10 one-bedroom houses, you said?
Yeah.
That was the light bulb moment, and you're like...
Well, it was actually the little one. It was the little one that I cut into 3. Yeah. But then the when the sales hit on the second site, that was we're on.
Yeah.
We're on. And so we had found a product that we developed ourselves, that we truly believed in, that we could sell, that we had a margin in. And that was sort of the foundation of the Williams Corporation empire. And it was a product that was non-traditional, that we created, we believed in, we wanted to sell. And I could sell that product all day, every day. If I'd sit with someone and I'm like, do you believe in the city? Buy your ticket.
Yeah.
Buy your ticket. It's only going to cost you $60,000 of equity from your family home. Buy a ticket. And back then, interest rates are 4 or 5%.
Yeah.
It was an easy pitch. And so we grow this business, and then you start to learn different things, right? So firstly, the sales channels couldn't keep up with the vision that I had. There are lots of little pokey offices that would sell 10 here, 7 there, but no one could consistently sell 20, 30, 50, 100 a month. So I went over to America, went to a whole lot of sales conferences, read all the sales books, and I built all the marketing books, and I built a sales machine. And so I had in-house commission-only salespeople. I had Facebook marketing where no one had tried to sell houses on Facebook. I'd buy leads for $3 a lead, have hundreds of leads coming in a day. I set up people in the Philippines processing the leads, sending them the emails, loading them in. We had proper pipelines of each step, what you do. We set up a proper sales channel, which no one had done it like the Americans, and no one had done it with the infrastructure and the technology and the CRMs and the automation that was available. The housing market was still very archaic. So I developed this sales machine, which started taking us just to the next level with horsepower. And then once I just developed the sales team, the banks stopped giving us money. So like at one point we were like, we might have been QBank's largest active trading customer with like $30 million. And in property, it's not a lot of money.
Yeah.
And so the banks were like, you have to grow at this rate. You can't grow at the rate you want to do. And this isn't actually Kiwi Bank, just for clarity. It was another bank, and the bank doesn't matter. But
so they were telling you to slow down, and you had this vision of, I want to build I want to take on the world.
Yeah. And they set some arbitrary growth goal that we're allowed per year that might have been 30%, and we're doing 100, 300%. And so I walked out of the meeting once with a banker that said what growth goal that we were allowed to hit. And I said, Blair, no one's ever going to tell us what we can and can't do with our life. I said, especially a banker. I said, we're going to be our own bank. And so we went and so I said, well, how do I be our own bank? And so I had these little investors that were funding blocks of 5-6 townhouses, but our projects were getting bigger. And so I sat down with some of my investors and I'm like, can I put you all together in a company and you'll take security over the projects I'm doing? And now instead of paying you each year when each project finishes, you get security over all of the projects and I'll pay you each quarter.
Yeah.
And my investor's like, yeah, that's awesome. It's rock. And so I made this company called Williams Corporation Capital, which was a wholesale finance company. It took securities over the work we were doing and paid our investors a 10% gross return with dividends paid quarterly.
Yeah.